Hi, folks. This is Mike Zlotnik, Big Mike, and today we're going to cover 4 main benefits of investing in real estate. So let's start with these 4 wonderful letters, CADA. That is all you have to remember these 4 main benefits. CADA. C stands for cash flow, A stands for appreciation, D stands for depreciation, and another A stands for amortization. We'll cover that in a little bit more depth in this about a 5 minutes video. So let's start with C, cash flow. Cash flow is what most investors would like to see out of investment in real estate. And just let me just be very clear, cash flow could be positive or negative. There are projects with positive cash flow from the get-go, from the start, and there are projects with negative cash flow, such as heavy value-add projects. So we'll talk about value-add projects in another video, but these are the projects that require a lot of work before property will cash flow. If, for example, you bought a distressed property that needs some work, needs to be fixed up before it can be rented out. Immediately, it has a negative cash flow. Over time, when the property is fixed up and rented out, it will have a positive cash flow. That's just a simple explanation. So cash flow is what is left after you collect rent on a property, pay operating expenses, and then pay the mortgage. What's left over is known as the cash flow. By the way, this is true for both residential and commercial properties. The concept is the same. The rents could be collected from tenants on a small duplex, triplex, or a quad, or a multifamily, or rents could be collected on an industrial property, or self-storage, or a shopping plaza. They just have different operating expenses and different mortgages. But the main principle is the cash flow is what you get after receiving rents, paying expenses, paying the mortgage. Now let's go to the next benefit. The next benefit is appreciation. Appreciation simply means growth in the price of an asset. And the reason it is a critical part of the investing is that in certain markets, the cash flows are light. For example, New York City. In New York City, typically a cash flow in the invested capital is low. So you can invest $1 million buying a property, and your cash flow could be 2% a year in New York City, which is small, which is not exciting for many investors. In some markets, you can get a cash flow of 10% per year. These are typically smaller markets where you get much better cash flows. But if you go back and you think about it, why folks invest in big cities like New York? Well, they invest for appreciation. Appreciation simply means the prices of the assets grow over time. Some folks talk about hedge against inflation, real estate being a great hedge against inflation. Well, it is true. Real estate is a great hedge against inflation in general. And the way it hedges against inflation, inflation raises prices on everything, including real assets. And real estate is a real asset. And the price of commercial and residential real estate generally appreciates over time. It doesn't move in a straight line. Sometimes prices go up, sometimes the prices go down. But on a long-term basis, over long periods of time, real estate has shown strong appreciation. And by the way, most of the wealth has been built in this country slowly over time in real estate. This is one of the most steady, predictable investments that folks can have. Real estate is it. That's the reason folks invest in real estate. One of the main reasons is appreciation. So we covered that. Now let's talk about the D, CADA. D stands for depreciation. Depreciation is a great tax benefit. It's a pseudo expense. That's the best way to describe it. The government, the tax code allows real estate investors to deduct a wear and tear, a use of the properties over time. And there are depreciation schedules for different type of properties. So in the simple term, residential real estate is depreciated over 27 and a half years. And commercial real estate is depreciated over 39 years. This is known as a straight line depreciation. In other words, the government allows a commercial real estate investor every year deduct 1/39th of the price they pay for the asset. So let's use an example. Let's say it's a commercial shopping plaza, small shopping plaza, and real estate investor paid for it $3.9 million, just really small. So $3.9 million was paid for the property. If you divide 3.9 million over 39 years, straight line depreciation, over every year, there would be $100,000 deduction, pseudo expense for the wear and tear of the property. Now, there could be repairs and other expenses, but in addition to that, the owner of the property gets to depreciate 1/39th every year on a straight line depreciation. The real estate has also some wonderful, wonderful benefits known as the bonus depreciation. And bonus depreciation is something that allows many real estate landlords, basically, they can accelerate depreciation of certain parts of their properties over faster periods of time. And bonus depreciation allows that to take place in 1 year, which is amazing. So what parts of the depreciation can be accelerated? So there are certain parts that are known, of certain parts of the property that are known to be have a shorter lifespan, 5-year lifespan, 7-year lifespan, 15-year lifespan. So let me give you some examples. For example, carpet in a property. It doesn't live 39 years, so it gets depreciated a lot faster than that. Appliances get depreciated a lot faster than that. You have a number of other small items in the properties, the doors, the doorknobs, the kitchen cabinets. Number of things just, they don't live that long. Even roofs don't live 39 years. So there are plenty of parts of the commercial building, residential, that could be depreciated faster. And the way it gets done is through an engineering study. The study is known as the cost segregation study. So an engineer gets hired, they do cost segregation of the foundation, of the walls. Those things get depreciated over a long period of time. But there are plenty of components, like a refrigerator. Its lifespan is not going to be 39 years. It's going to live over a 5-7 year schedule. And during that, and that schedule can be accelerated in 1 year. It's a very, very powerful benefit that many real estate investors take advantage of. They run a cost segregation study, and the CPA basically takes it as a bonus depreciation all in the current year. It's a very powerful benefit, but one of the main concepts of depreciation is you can use depreciation to offset other income you have on this property. And many folks would use one property depreciation loss to offset gains from another property. From essentially, passive gains can be offset by passive losses. It's another conversation. We'll talk about this, but it's a very powerful benefit, and I'll cover more in greater depth. How do you use depreciation benefits from one property, creating substantial losses to offset gains from another property? It's another discussion. So CADA, we're going to the last letter. The last letter is also A, and that stands for amortization. Amortization is a powerful benefit that over time builds more and more equity in the property. So what is amortization? Amortization simply means principal pay down. So you can have a mortgage where you're making, so let's just use an example, $10,000 a month payment. Of that $10,000 a month, $9,000 is interest and $1,000 a month is principal pay down. That principal pay down is amortization. So over time, so if you paid every month that $10,000, a year later, you will reduce the mortgage balance by $12,000. And that is known as amortization. You basically paying down the principal, reducing the mortgage loan, and that's creating more equity, more value in your investment. So these are the four main benefits of real estate investing, CADA. I hope this was helpful. Appreciate your time and attention. Until the next time. Thank you.